When you think about investing in cutting-edge AI, you're probably picturing some flashy software startup or a huge semiconductor company, right? But what if I told you one of the most interesting plays is actually a 175-year-old company that makes, well, glass? So let's dive in and see how this old-school giant is quietly wiring the future of AI.
So that's the big question we're tackling today, isn't it? Can a company that's been around since before the light bulb was even a thing really be a smart way to invest in artificial intelligence? Honestly, the answer might surprise you.
Okay, before we even get into the AI hype or the stock price, we've got to answer a much more fundamental question. Is Corning just a good business, period? So let's pop the hood and really make the case for quality here.
Now this is where it gets really interesting. You want to know how Corning actually makes its money? You probably know them for the Gorilla Glass on your phone, but just look at the biggest slice of this pie. Optical communications, 38% of their revenue. This is literally the nervous system of the internet and, you guessed it, of all those AI data centers being built like crazy. And get this, that segment grew a massive 35% in 2025 alone. Wow.
So what's stopping a competitor from just swooping in? Well, this is what we call Corning's moat, its defenses, and it's a deep one. We're talking about a fortress built with patents, secret manufacturing recipes, and really, really deep relationships with customers. I mean, when a company like Meta signs a multi-year, multi-billion-dollar deal with you, they're not just a customer anymore, they're a partner. Tearing out Corning's tech would be a nightmare for them. That's what creates incredibly high switching costs.
All right, so all that strength sounds good on paper, but does it actually show up in the numbers? Oh, you bet it does. Let's run through a few key stats from their 2025 results. You might want to brace yourself.
First up, adjusted free cash flow. This is the real, actual cash the business generates. In 2025, it hit $1.72 billion. That's nearly double the year before. I mean, come on, that is an absolute cash-generating machine.
Next up, core earnings per share. This basically tells you how much profit is being made for each share of stock. It jumped 29% year over year. That is a huge, huge leap in profitability. And finally, core return on invested capital. This is a big one. It shows how efficiently they're using their money to make more money. It surged to 14.2%. So the crucial thing to understand is the more money Corning plows back into the business, the more profitable it becomes. That's a beautiful thing to see.
You know, a great company needs great leaders, and this management team seems to be hitting all the right notes. They're spending wisely to grow, not just recklessly. They're friendly to shareholders, returning over $1 billion to them last year. And you've got an experienced CEO at the helm, which means there's a steady hand on the wheel. The foundation here just feels rock solid.
Okay, so we've established it. Corning is a high-quality, well-run company that's growing like a weed. So, case closed, time to buy, right? Whoa, not so fast. This brings us to maybe the most important distinction in all of investing, telling the difference between a great company and a good investment.
This is the question you have to ask yourself every single time. It doesn't matter how amazing a business is if you overpay for it. So, what's a fair price for Corning? And more importantly, what is the market actually charging us right now?
And this is where we hit a pretty big speed bump. Look at this. On one side, you have the market's price tag, about $136 a share. But on the other, after a conservative analysis of what the business is actually worth, you get a value of somewhere between $62 and $87. That scale is tilted heavily. The market is asking you to pay a price that's nearly double the company's estimated intrinsic value.
Now, that huge gap is critical because of this concept called the margin of safety. Think of it like an investor's personal safety net. You buy a great company, sure, but you try to buy it for less than it's worth. That way, if you're a little bit wrong or if the market goes crazy, you have a cushion. With Corning today at this price, that safety net is basically gone. You're paying full price, maybe even more, leaving you zero room for error. So why on earth is the market willing to pay such a crazy premium? And maybe more importantly, what could happen next? To answer that, we've got to look at the stories that are driving all this hype, and then see what the technical charts have to say about it.
So there are three really powerful stories that are fueling this stock. First, that AI data center boom we already covered. Second, this emerging and potentially trillion-dollar market for carbon capture, where some of Corning's old tech is finding a whole new life. And third, the demand for tougher, more advanced glass for premium gadgets like foldable phones. And to be clear, these are all very real, very powerful trends. The thing is, the market seems to have priced in all of this good news, and then some. It's like it's assuming a perfect future with no hiccups.
But markets, they move in waves of psychology, optimism and pessimism. So let's switch gears and look at a tool that tries to map those waves. It's called Elliott Wave Analysis, and let's see what it's telling us.
Now, don't worry about all the crazy lines here, just focus on the basic pattern. This chart is suggesting that Corning has just finished a massive, powerful surge upwards, which is labeled as Wave 3. And according to this theory, after a big, impulsive move up like that, a corrective move down, what they call a Wave 4, is pretty typical.
And this table puts some potential numbers to that theory. The part you want to focus on is Wave 4. The forecast is for a correction, a pullback, down to somewhere in the $110 to $120 range. Now, if that happens, the theory then suggests another potential rally, a Wave 5, could come after, with a target of over $200. So, the chart seems to be agreeing with the valuation analysis. The price might be too high right now and could be due for a pullback.
Okay, so let's bring it all home. We've got a fantastic, high-quality company on one side and a very, very high price tag and a chart signaling a potential drop on the other. So, what's the verdict?
I think this one quote from the analysis just sums it up perfectly. Enterprise quality and investment value are not the same concept. You can absolutely love Corning the company, its innovation, its management, its future, and still come to the conclusion that at today's price, it might not be a good value as an investment.
So ultimately, it leaves us with this question. We are looking at a phenomenal company, but it's trading at a phenomenal price. The analysis seems to suggest that maybe, just maybe, patience is the wisest move here, waiting for a better entry point where you get that all-important margin of safety. So I'll just leave you with this. What's your margin of safety? It's a question worth asking for any investment you ever make.